if you thought the jobs report would be important, it is. And it's going to be very important this week. And we have a lot of data that's going to be equally as important. So make sure you stick around, find out what I think is going to be the most important data coming out this week that's going to move the markets. My name is Blake Morrow with Forex Analytics, and you're listening to the Week Ahead video. Thank you so much for being here today. You know, as you can see, it's not just about jobs. Yes, we have a short and a holiday week, but we have Swiss CPI, we have ISM data, not only the services, but the manufacturing data. We're going to get both of them this week. We're going to get Canadian jobs report. And speaking of Canada, we're going to have the Bank of Canada rate decision. So it is going to be an extremely busy week in the market. And for those of you that are just coming back off holidays, welcome back. We've missed you, but you missed a lot of volatility, but don't worry, there's more to come. So let's get into what I think is going to be really important going into this next week as far as the markets go. And actually, we're going to start off and talking about, you know, some of the things that happened at the very end of last week that I think is important to understand. So as we were talking about last week, the market was the retail market was very long US dollars. And, you know, we saw the dollar actually recover a little bit last week. At the end of the week, we were expecting month-end flows of some dollar selling, but in turn, we got a little bit of dollar buying, excuse me. So the banks were off, which doesn't surprise a lot of traders, but that's given us a lot of opportunity for the markets and what we're seeing currently. Now, I'm going to show you a chart that's really interesting from, this is from Bloomberg, as you can see. But I'm going to show you that speculators turned dollar bearish for the first time since February. Now, as you can see down below over here, you know, speculators are turning bearish. Now, the reason why I think that's important is because, and let's pull up the dollar index really fast. I'm going to reference that chart actually a couple of different times, because I want to show you the last time, and let's go out to the weekly chart. That's a monthly chart. Let's go to the weekly. No, that's a monthly. This is a weekly chart. Okay, here we go. If you look at the dollar index and go back to, let's go back to 2022, right? That's right here where we saw that big rally in the dollar index. All right, go back to 2022 and see where the speculators right here were very bullish. This is hedge funds, right? This is the hedge fund community. Very bullish the dollar index in 2022 and through 2023. And you can see what the dollar index did throughout 2022. And then 2023, it started to turn lower. So all of 2022, it went really bullish as speculators were very bullish going into that year. Now, notice back in 2020 when they turned net bearish, just like they're doing right now. Net bearish in 2020, and see what the dollar did back in 2020. In 2020, the dollar, whoops, let me grab that drawing tool. The whole year, 2020, the dollar went down quite aggressively. Remember, that's what the speculators are now doing here. Now, they also went bearish in 2023, basically just before the beginning of 2023. And you can see in 2023, right here, through, you know, October 2022 through June of 2023, the dollar went down, and that's where speculators were bearish as well. So this turn in sentiment in speculators, this is like, you know, non-commercial hedge fund type of traders. They're just starting to get bearish the U.S. dollar. We need to take heed of that because of how the dollar has reacted back in time when they have turned bearish in the past. So that's a pretty important piece of information. Then also, like I mentioned last week, retail traders are still very long US dollars, and that hasn't changed much. Now, they've had a little reprieve this last week because what we've seen in the dollar index, and let's go over to the daily chart, is the dollar index has recovered, but look at where we've recovered to. And we're going to do a lot of work with the US dollar index here because, you know, if you look at the last move, we're coming back up towards the 50% retracement. If you take the entire move down, we're just at the 24% retracement. So basically what I'm saying here, and let me redraw the other fib level. Between this 24% retracement we're basically at to the 50% retracement of the most recent leg lower, I believe that the US dollar is about ready to turn lower. Now, again, there's a lot of information coming out this week. There's a lot of economic data, and a lot of traders and a lot of macro analysts believe that the market is a little bit too aggressive in its pricing for Fed cuts going into the remainder of this year, which happens to be about a full basis point, or 100 basis points, excuse me, or whole percentage point. So 100 basis points of cuts, that means that, you know, one of the 3 Fed meetings this year, and one of them being, you know, here in the next couple of weeks, one of these meetings, the Fed would have to cut by 50. Is that too aggressive? Is it not? Well, I think this week is going to tell us a lot about that pricing as we get all of these components that are the jobs cuts, or excuse me, on the jobs data, ISM, JOLTS, weekly unemployment claims, both ISM data that I just mentioned, ISM, but manufacturing and services, the employment components in there, and the jobs report as well. Now, if you are not part of the Forex analytics community and you're not in here having conversations about what's going on in the markets, what's moving, what currency pairs might be flying around, make sure you join us in the Forex analytics community. We have, and you're going to see it right here, and probably on Monday, you're going to see our new pricing schedule, which is our sale that we offer at the beginning of the trading season. Because, as you all know, we feel that this is the beginning of the trading year, starting in September. So for the month of September, we're going to be offering those steepest discounts that we ever give for Forex Analytics, which we only do a couple of times a year. So make sure you take advantage of it. Again, it doesn't show it right now on this site, but if you look back on Monday, you come back on Monday, you will get the absolute lowest prices that we have for Forex Analytics ever throughout the course of the year. So jump on it, take advantage of it, because when it's gone, it's gone. And traders know that. And they know that they need to take advantage of it when it's here. So make sure you do that. All right, so let's go through, we're in the Forex Analytics system now. You can always analyze, 30 different currency pairs. You can see different types of analysis, from basic, harmonic, Elliott wave analysis, macro analysis. You have live squawk feeds, risk management tools, and also the chat rooms. You'll notice that right up here. Whoops, that takes us to this one. Excuse me. I already had one launched, so I can't launch them 2 times in a row. So there's a chat room right here, and that is the most active part of our community. Plus you have private shows, whether it's the Morning Edge, the Daily Roundup. Those are shows that are only for Forex Analytics subscribers. All right, so going into this next week, let's talk about it. And I know I already gave you a lot of information about the dollar, but let's start off with Monday. Monday we have, obviously, it's a Labor Day, it's the Labor Day holiday in the US, so it's a shortened week for a lot of us, but not for everybody. And just by the way, the Flow show, which is the European show that is broadcasted by Ryan Littlestone and K-Man, that will be broadcasting on Monday. And if you're a Forex Analytics subscriber, Steve Vulgaris, he will be doing the Morning Edge, which is a private show for Forex Analytics traders. So just realize those guys are all, from the UK and Europe. They're not celebrating our Labor Day. I will be, and so will Dale Pinkert. So, but you can still listen to some of our broadcasts on Monday. But on Monday, we're going to have Mexican business confidence, Norwegian PMIs, South Africa, not S&P PMIs, but private sector PMIs. Those are going to be out. Now, I want to talk a little bit about what's happening with the US dollar Mexican peso, because the US dollar Mexican peso, as you recall, and we haven't looked at it in 2 weeks, we were looking for a rally from the 1860 level, and boy, did we get one. Now, there's a lot of judicial reforms that are happening in Mexico, and we're getting to levels that are very, very big as far as a resistance level goes. I want to show you really quick on the US dollar Mexican peso. This is the long-term 38% retracement right here at 20. And it's 1980s, right where we're currently at. We're trading at it. As most of you know, a break above 2020, which is the most recent spike highs, is probably going to be extremely bullish for the dollar Mexican peso. Now, the question is that you might be asking is, why is the Mexican peso so weak? It's weak because there's a lot of judicial reforms that are happening where, Supreme Court justices are being replaced by judges of popular vote, which many analysts believe could be an open invitation to a lot of corruption in the judicial system. So not only do we have that, but we have a new president. Even though it's AMLO's protege, Sheinbaum, she's coming in to be the new president of Mexico. A lot of investors feel there's going to be a lot of uncertainty around Mexico, which could allow for further Mexican peso weakness. On top of that, we have a U.S. presidential election. And I'm just going to say, if Donald Trump is reelected, which looks like a very good possibility of that happening this election year, he could be really hard on Mexico as well. So the relations between U.S. and Mexico could be disturbed even further. So if you talk about new cabinet members in Mexico, judicial reforms, which opens up Mexican government to a lot of corruption, which is going to be less business friendly. Then you throw a Trump presidency on top of that, we could have a situation where the dollar Mexican peso is trading well above 20 and back into the low 20s, like 22 to 23. There's a very significant risk of that, and I think investors are sniffing it out because we're seeing the dollar Mexican peso get towards 2024 highs, and there are levels that we have not seen since 2022. That could continue in the weeks and months ahead. So just keep an eye on the US dollar Mexican peso. I'm just going to show you really quick. I'll zoom in a little bit here. I'm going to be a buyer on any significant dip towards 19. So just, narrowing it into the chart so you can kind of see, whoops, let me take that back. Any up closer view here, you can see we're right at the 88% retracement. Again, we're in the support zone, or resistance zone. Any dip back down towards 19, I am looking to reestablish longs into new not all-time highs, but new weekly highs. So Mexican peso, make sure it's on your radar. And that's not the only Mexican data, because if you go into Tuesday, we will have Mexican employment. Now, speaking of Tuesday, we need to talk about the Swiss franc. The longer term, I'd showed you guys this chart. This chart we've had developed for a long time. We thought this might be a right shoulder of an inverted head and shoulder pattern. Is it still a shoulder potentially? I don't necessarily think so. What I do think is the dollar, and it really could still establish itself. What it is doing though is we are trying to create a higher low in the Swiss franc. Now we do have Swiss CPI, and the Swiss CPI, although it is expected to come in a little hotter than expected, a little bit hotter than the previous month. How about if it doesn't? And if it doesn't, could that weaken the Swiss franc and allow us to move a little bit higher in the near term? I think so. Now, I'm also short Swiss francs, not in the US dollar Swiss franc. I am actually long Euro Swiss personally, as I'm playing a bit of a recovery because I know the Swiss National Bank is not too happy with the Swiss strength that we've seen as of late. But both the US dollar Swiss franc and the Euro Swiss could get some upside potential if Swiss CPI comes in weaker than the hotter number than the market expects. I hope that makes sense. Also, we have Swiss GDP that just like an hour later, which could influence the market as well. Now we have South Africa GDP. I mentioned that we have South African PMIs on Monday, like private PMIs. Then we have the S&P PMIs that are on Wednesday. Actually, I don't know if that is private PMIs on Monday. I have to go back and do a little bit more digging. But I do want to show you the US dollar South African rand, because I have been on the short side of this for the last few days. We got a little bit of a bounce on Friday because it was end of month flows. And by the way, let me stop for a moment. I'm going to come back to that. I'll come back to what I was just going to say about end of month flows. But anyway, we have the US dollar South African rand. We're below major triangle resistance because it was previous support. It is currently resistance. We've got to watch the dollar Mexican peso. As long as it's below 18, the risk remains for a continuation down towards the 1740 level, which will be obviously very, very important support in the weeks ahead. So just keep an eye on the US dollar, South African rand. One of the comments, actually, if you read, some of the comments that came from South Africa, I think it was, I want to say it was on Friday that the government also referenced that they believe that the recent South African strength that you've seen is because of the political stability that you've seen in South Africa. I'm not going to say anything about that because I believe it to be true. And we were talking to K-Man on the F.A.C.E show on Friday, and one of the things that he mentioned is, South Africa has gone for one of the longest periods of time in recent years of not having a power outage in the country. And that type of stability, whether you're talking about economic stability or political stability, could really allow for the South African rand to rally further, especially if we continue to see dollar weakness in the weeks ahead. So just watch the 1740 level in the US dollar, South African rand. I do believe it's going to be very important. One of the other things that's happening on Tuesday is we have Mexican employment, but I showed you the dollar Mexican peso. But I do want to talk about the dollar index because this is where we start getting, U.S. data. We'll have ISM manufacturing data coming in on Tuesday. Now we're going to talk a little bit about the rally that you saw at the end of the month. So when you have end of month flows that are being pushed through the markets, whether it's in this case it happened to be dollar buying, where most banks thought there would be dollar selling, but we got dollar buying, probably as a result to a lot of the European data showing up a little bit weaker this last week. A lot of these end of month flows, when they get pushed through, especially on an end of summer week like we had this last week, there's low liquidity. No one wants to stand in the way. So all this dollar buying came through at the end of the month. A lot of times, as we come back into the first of the month, you're going to see that buying or selling that was predominant at the end of month flows reverse. And knowing that the dollar index is in a very strong downtrend, especially over the last month, you can see, month, 2 months, how weak it's been. I wouldn't be surprised if a lot of this dollar buying gets unwound here at the beginning of the week, this next week. Now I'm going to talk about the euro in just 1 second because I know we're referencing the dollar index, but the euro has really been on my radar as well. But I just wanted to mention about month-end flows and how important they are, and especially the week following, what could happen, especially following Tuesday if U.S. data starts to show some signs of weakness. We could see that dollar give back some of that bounce that we've seen. Remember, we are in a strong downtrend for the last couple of months, and we are outside of a triangle consolidation, which does suggest that this rally will be short-lived. Now, I do want to talk, since we don't have any strong European data this week, I do want to talk about the euro a little bit because last week we were discussing the euro at two levels, 111.40 and then 110.50. You notice we closed at 110.50, and I'll talk about this more at the discussion at the very end of this video, where I talk about my 3 best setups from last week and we review them, and the 3 best setups for this week. I thought the dollar would get a little bit weaker before it pulled back to 110.50, but here we are. We're basically at 110.50, which is a breakout point right here. So between, let me grab my drawing tool that I want. Between 110.50 and 110, I do expect that the euro is going to find its footing. I talked about this on our F.A.C.E show, that I don't think that triangle was really the triangle we should be looking at. The blue one is the symmetrical one, which means that, any dip back down towards the breakout point, call it 110, maybe even 109.70, that should be very well supported on dips now on the euro dollar. I'll talk more about that here in the next couple minutes, so make sure you all stick around for those 3 best setups and reviews from last week. That's at the very end of this video. All right, continuing on. One of the big pieces of data that's coming out this week that is not US related is the Australian GDP. Now, the reason why this data is so important in the Aussie for Australia is because traders are starting to believe that the RBA might actually be closer to cutting rates than raising rates. You know, one of the big risks for the Aussie bears has always been that the RBA might raise rates before they cut rates. Now, if Australian GDP data comes in a little weaker than expected, which it is expected to be stronger, but if it comes in a little bit weaker, yeah, we could see the Aussie come back down a little bit, especially as we reject the 68-cent level. But the fact of the matter is we had a false breakdown, right here, even though it was ever so slightly, a false breakdown of horizontal support. And a false breakdown usually leads to a breakout. So if that Australian GDP data does come in stronger than expected, and just so you guys know, quarter over quarter, the market is expecting 0.2% versus 0.1% the last quarter. But if Australia is dealing with higher inflation, stronger jobs market, and GDP ends up being stronger, that could fuel the idea that the RBA, they may not be raising rates, but they might end up keeping rates at current levels a lot longer than the rest of the G10 countries that are currently cutting rates, like the US, like Eurozone, like the UK, which might cut rates again at least one more time in this year. So keep your eye on the Aussie dollar this week, above 68 cents, especially if we get a foothold above last week's high, which were 68.25 roughly, or 30. It's going to be very bullish. So Australian GDP Tuesday night. Also, just so you all know, it's Tuesday night or Wednesday morning in Australia. Thursday morning, RBA Bullock is speaking at the Anika Foundation in Sydney. We are expecting audience questions, so we'll see how hawkish the RBA is when Bullock does speak on Thursday morning. So just keep that in mind. It's going to be a big event this week, especially non-US related event this week. All right, going into Wednesday. So like I mentioned earlier, we have South African PMIs. We'll have S&P PMIs. We'll have business confidence out of South Africa. But the big non-US event will be the Bank of Canada. Now, the Bank of Canada, just so you all know, this Bank of Canada rate decision is expected for a rate cut. They're expected to cut rates from 4.5% to 4.25%. Now, that could lift the dollar CAD, like we were talking last week, up towards that 135.50 or 135.50 to 135.70 level, maybe to the 200 DMA. That is still a high possibility, especially if the Bank of Canada sounds, dovish going into the BOC meeting. The other thing that we have to take into consideration, since we're dealing with the dollar CAD in this instance, is how weak some of the employment data might be ahead of the non-farm payroll on Friday. So if the ISM data is coming out weak, the manufacturing we're already going to get a look at. We're going to get services the following day on Thursday. We're going to get ADP on Thursday. How the dollar Canadian responds around here is going to be very important, factoring all that in. So I do think that any move towards the 200 DMA is going to find some selling. All right, staying on Wednesday, we do have the JOLTS jobs data. We do have the Bank of Canada press conference after that data. So there's a time, I believe it's about an hour or so. Let me confirm that. It's actually 45 minutes between the rate statement and then the press conference. So there is some time before the Canadian press conference, the Bank of Canada press conference on Wednesday. Going into Thursday, like I mentioned, Thursday morning, RBA Bullock is speaking. We're going to have UK construction PMIs. So let's take a really good look at sterling. Now, sterling, as you can probably see here, we might have put in a false breakout. Let me fix that line because that is not correct. We might have had a false breakout at the end of the week this last week, which, you know, that on a weekly basis, if you look at the weekly candle, that's not really a good look. But I think how the dollar responds this week is going to be more important, because I still look at the sterling as very constructive, and it looks really, really quite, you know, constructive while you're above this 130.50 level. And if you look at this, let me delete these little circles here. If you look at the pullback from low to high, we're only at the 24% retracement. Now, if we're only at the 24% retracement, I want you to go back and think about what I was saying about the end of month dollar buying that we ended up getting. If we end up reversing that at the beginning of the week, the pound might be trading close to 132. Now, depending on what happens with the rest of the week, you know, as far as U.S. data goes, if sterling is only limited to a 24% retracement, shallow retracements usually mean continuations. So the risk would be, if we hold, you know, this, you know, 24% retracement. Let me delete some of that stuff. Okay, if we hold this 24% retracement, or maybe we get down to a 38% retracement, the path of least resistance still remains higher, especially if that construction PMI comes in better than expected. And again, that is early Thursday morning. So on Thursday morning, we also have US ADP, weekly unemployment claims, and services PMI. I've already showed you the dollar index, and I think that's the one you really need to be focusing on Thursday. Actually, you know what? I'm going to take that back. Since we have all this data on Thursday, let's take a real quick look at the US dollar Japanese yen. The US dollar Japanese yen, as most of you all know, I do believe there's an ABCD move. The problem that I feel with the US dollar Japanese yen, especially speaking with my contacts at different brokerage firms that are retail oriented, I think a lot of retail traders are expecting Japanese yen continuation in strength. So they're all positioned basically short dollar yen, or short euro yen, pound yen, Aussie yen, whatever yen you want to talk about. They're long yen. Retail is. Now, I believe they're eventually going to be right, but could we end up getting a little bit more of a squeeze higher before a move lower? And I think that is the risk of not only the dollar yen, but other yen pairs too. And don't worry, stick around. For the end of the video, I will be talking about one of those yen pairs specifically. All right. Moving along into Friday, we're going to have U.S. jobs report. We're going to have Canadian jobs report. And then also FOMC Williams and Waller will also be speaking after the jobs report as well. So I've already showed you the dollar CAD. I've already showed you the dollar index, and I've showed you the euro and the US dollar Japanese yen. So I don't think we need to talk about anything else dollar centric at this point in time. Moving right along, we have gold that I do want to look at, because gold continues to hold its gains despite having a little bit of a pullback on Friday. You can see that we're just nudged up against the highs, and so the analysis stays the same as last week. The RSI has worked off overbought conditions. Yes, it's divergent. But what happens, and this is the same analysis that you got from last week, I'm giving it to you this week. We're just nudged here up against the highs. What happens if gold continues to break out? What'll happen with RSI is RSI will break out to the upside. So don't be bearish gold unless you get below wedge support. You start breaking back below, let's call it 2400, 2420. This is where gold turns bearish, right through here. But until you break back below there, I don't think you should be looking in that direction in gold. It seems like we're just wedging higher, getting ready to break out even further. Now, silver is a little bit different of a story. Silver has had a nice little bounce and a correction. I do believe silver's in no man's land at this point. So your best bet, if you want to be, if you're a silver bull, is buying it, lower at the 200 DMA, looking something like this. Buying it down there, looking for a dip to buy. But the flip side is if gold goes up, silver is probably going to be dragged higher as well. I do want to talk a little bit about copper and about crude, because copper has really critical resistance here at 430. If we can get above 430, then this would turn actually bullish. All right. Now let's delete this fib and let me just show you how important that 430 level is. That 430 level, its previous support, current resistance, right? So if you break above that, you should be challenging the 38% retracement. So above the 38% retracement, it gets very bullish. So, a lot of people will be buying, the dollar, or excuse me, the dollar, copper above the 38% retracement, which is 440. But if you have a 10 cent, head start, from other traders, that's a benefit. Now, while we're below 430, though, you have to be a little bit more careful. I do want to talk about crude just very briefly. I think crude oil, and we haven't looked at it in a few weeks on the show. Obviously, we were looking at an inverted head and shoulder pack, then it completed. So I'll just delete it because it looks like we're just consolidating. So right now, I think if you are dealing with crude, you just have to be more cognizant of this level of support near $72. And while we're above $72, it's supported. But while you're below the 200 DMA, that's probably where you should be on the short side. So given the fact that we're right in the middle of this range, a break above the 200 DMA or those range highs would be bullish, and a break below 7150 would be bearish. So this is your range that you're dealing with in crude. And I wanted to reference that because I think it should be watched carefully in the days and weeks ahead. I also want to talk a little bit about the bond market, because the bond market, you'll notice, well, this is the 10-year note, but whether you're looking at the 30-year or the 30-year or the 10-year, you're going to get basically the same thing. What you can see is the 10 years pulled back a little bit. But what happens if that data, if the jobs data turns a little weaker this week? What could happen in the bond market is you would see the bond market reverse, or in this case, it'd be the 10-year notes. If they reverse and we start heading higher like this, that means yields are coming down. That means that means that the economic data was probably fairly weak this week. And if you're sitting there wondering, how I feel about the labor market at this point, my opinion is I have to see it to believe it. I mean, I thought U.S. labor market, I believe the U.S. labor market is much healthier and has continued to show us how healthy it's been all of 2024, where, I had expected, us to be seeing job losses by now. And since we're not, I think most of us that are watching the U.S. labor market, we need to see the data turn decisively south. So it's hard to be really negative on U.S. jobs until we start to see further evidence of that. And I think this week could give us a clue. But if you're going to go into this week expecting weak U.S. data, I don't know if it's premature yet. But based on history, the job market, does seem like it is much healthier than people seem to believe. Yes, I know about the big revisions from a couple of weeks back, and that if you get a jobs number, you might as well just take 50,000 off the top of it because of revisions. I get all that, but regardless, I thought we'd actually be losing jobs by now, and it has not shown that to be the case as of late. Now, the question would be, and this is where we're going to talk a little bit about the S&P, is where do I think U.S. equities are going? Well, frankly, it's kind of like gold. When you are poised right at near the highs, I believe that new highs are coming. Now, we should stop for a moment, and I'm not going to show you every market. If you want analysis on every indice, you can go into the S&P room, and you talk to us there, and you can see where. And I'll show you some charts really quick of charts that I post of the Nasdaq flagging, the DAX, trading at all-time highs. You can ask me those questions inside the Forex Analytics community. And remember, this month is going to be the lowest prices you'll see on Forex Analytics throughout the course of the year. And historically, we do it, in the first couple of weeks of September. So as of Monday, you'll be able to get that great pricing. But I'll just stick with the S&P right now. And notice how the S&P has shrugged off NVIDIA earnings. It's shrugged off pretty much everything. And US data has been, actually, let's go back to earnings. Earnings have been strong. Even when NVIDIA missed earnings, all the companies that reported that day on Wednesday reported a beat on, top end revenue forecasts. I mean, if you think that US corporations are doing poorly right now, they're not as of right now. Now that's backward looking, it's what has happened in the past. But the stock market will start showing signs of weakness when companies start reporting bad earnings, or we start to see a significant deterioration in economic data. So what does that mean for the S&P? Well, it means that we're probably staring new highs in the face going into this next week. Now the question will be, and this is the question that I'll be asking, is how would the US equity markets react if we have a weakening labor market? So let's just say next week, and I do not know, but I'm just going to use the assumption that US economic labor data starts to show signs of weakness, and we don't create as many jobs as the market's expecting. I mean, the market's expecting us to create 150,000 jobs or somewhere in that neighborhood. Let's say we only create 50,000 jobs. Is the stock market going to see that as a good thing because that means that the Fed may cut rates a little bit more aggressively? Or will stocks believe that is a bad thing and stocks will start going down because our labor market is significantly moving in the wrong direction, and a lot of people feel that as soon as the Fed starts cutting, you got to start selling stocks anyway. So I'm not sure what the answer to that is, but I will tell you from a price action standpoint, the stock market the risks are increasing because we're not pulling back. The risks are increasing and tilted to a higher risk of an upside breakout versus a downside breakout. And there's so many bears out there. There's so many macro bearish economists out there that perhaps the stock market needs to make a new high first. So keep that in mind as we navigate through this week, especially with all the jobs data that we're seeing. One last thing I should mention before I talk about the trade setups from last week is I should mention Bitcoin and crypto just in general. Bitcoin's obviously the outperformer. I mean, you look at Bitcoin, Bitcoin's holding up fairly well where Ethereum actually is trading a little weaker. Whoops, that's Bitcoin still. Here's Ethereum. Ethereum's trading a little weaker. Bitcoin actually looks a little bit better. And I think that we need to reference that, that Bitcoin still looks decent. I'm not bearish. I'm not bullish. I'm just more Bitcoin agnostic right now. But looking at the longer term charts, I mean, we're still setting up a big cup and handle pattern. It still is. And until proven wrong, that means Bitcoin would have to get well below 50,000 here, somewhere below here. We start trading below that, and then that becomes a risk for the longer term bulls. But while we're consolidating, it doesn't look bearish. It looks more bullish than anything. All right. This is the point that I want to talk about. Review the setups from last week, and then I'm going to talk about the three setups from this week that I have for you. So the first one we talked about last week, I said long euro dollar, any dip to 110.50, and then I also mentioned 111.40. So 111.40 was a very minor dip. It was here, and once we broke through it, it didn't work. Now we got to 110.50, and I think if you picked it up at 110.50, because we talked about it last week, I think it's still in process. So we'll have to come back and review this one because I think it's dipped to a level that buyers should be stepping in. And like I said earlier in this video, if the end of month buying of US dollars reverses at the beginning of the week, which happens a lot of times after end of month flows have been, pushed through the market, then you get a reversion back to the mean, if you will. That might have been the best place to pick up the euro dollar. So I'm going to call that one in process for number one. Number two, I said sell the dollar Canadian on a rally to 136.50, 135.60 to 135.50, and we have not made it up there yet. I still think this is in process. So you can kind of scratch that. It hasn't, done it. The last one is long S&P on a breakout above highs targeting the 127% extension or dips to the 50 DMA. So neither one happened last week. So one didn't happen, the other one didn't happen, and the first one is in process. So, do you blame it? Do you blame us on at the last week of August, which is arguably probably one of the least volatile times of the year, which happened to have a lot of volatility this week? Yeah, I mean, it is the last week of the year. So this week maybe we'll make a little bit bigger difference. So this week, my first setup number one, dollar index. Now, I'm looking for the dollar index to get to 102.20 to 102.15. That would be equivalent of the euro dollar towards 110, or the dollar Canadian to 135.60 or 70. So again, we're just in process from last week, but I believe that that's a great setup to sell the US dollar into any strength. So the dollar index to 102.15. Let's go back to the dollar index. The dollar index to 102.15, I think, should be sold. All right, so that's setup number one. Setup number two is if the S&P makes it to the 127% extension this week, I believe you should short it. Now, I met with Jim Welsh of Macro Tides. He believes this is a wave 5. That means that a new high in the S&P should be sold. Gregor Horvat, who does our S&P analysis for Forex Analytics, also believes that this is a wave 5, and he thinks that if we get up here, it should be sold as well. And so I am going to lean onto my teammates that I've met with this week and say I agree with them. So if we get a move in the S&P, and I'm trying to adjust this really quick while I'm talking. There we go. If we get a move in the S&P up to the 127% extension, which is basically 58.35, I think you should be looking for shorts up in that area. Okay? Last but not least, I told you I'd bring you a yen pair, and the yen pair I'm going to bring you is the pound yen. Notice how we are nudged up against the 200 DMA. And I'm going to reiterate what I said to you earlier in this video. Retail is positioned long yen, and they're paying interest, and they're expecting, the dollar yen and all the other yen pairs to roll over. I don't disagree with that positioning. I actually think that that is probably going to happen. But before that happens, you might see the pound yen rally above. Now remember how bullish the pound looks. The pound yen above the 200 DMA, we might reach for the 50 DMA, which is right here, or the 161% extension right there, 197.50, before we roll back over. So if you want to play it to the long side, I think you can on a break above the 200 DMA, but don't look for, huge gains. It's just, from 192.50 to maybe 196.80. So you're talking about 400 some odd pips, and with the yen pairs, that is just a hop, skip, and a jump away. So guys and gals, I want to thank you for spending your time with me. And if you feel that these videos are very beneficial to you for getting ready for your next week of trade, please give me a thumbs up. Jump down in the comments below. I probably missed something this week. I'm kind of on holiday mode right now. It's Saturday morning of a long weekend here in the US, and we've got plans throughout the weekend, and so I might have missed something. If I did, jump down in the comments below and let me know. And then also, if you agree or disagree with any of my setups, jump in there and let me know. And give a big thanks to our team for putting this together for you this long weekend. And thank you so much yourself for spending your time with me. I know your time is your most valuable asset, so you spending it with me makes me feel good. So thank you very much. I will catch you on Tuesday on the F.A.C.E show after the long US holiday. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.